Now, the decision of the court is quite short, as you can see, but it's a 65-page decision, and this is just the conclusion of it. And we will look through a very particular part of the decision. But you can see on those grounds, the General Court hereby joins the cases TT, this number and that number. And what happened here was, remember that state aid cases between the Commission and a government. So the Commission sued Ireland, or required them to pay back the state aid. So Ireland then sued the Commission before the court of, the General Court, to say that the assessment must be annulled. But in the second case, actually, the Irish companies also sued the Commission and asked for the General Court to annul the decision. And since both concerned the same Commission decision, these cases were joined. And then the big piece, of course, annuls Commission decision 2017-1283 on state aid implemented by Ireland to Apple, orders the Commission to bear its own costs. In other words, so the decision from the Commission is annulled, there is no state aid, and the European Commission must bear its own costs, and it needs to pay those of Ireland and Apple Sales International and Apple Operations Europe, which were quite significant. I do not know if they are capped in any way, but if they had to pay the full amount, this would have been probably €1 million plus. And then it orders Ireland in the context of case T-892, the Grand Duchess of Luxembourg and the Republic of Poland and EFTA to bear their own costs. Now Ireland listed itself as the interested party in the case between Apple and the Commission, and the other countries did the same. And since they are only interested parties, they need to bear their own costs. Those costs are not borne by the Commission, even if it lost. Okay, now here you see a build-up of the decision, and you can see it is quite a lot of points that they cover. I'm not going to take us through all of this because then the video will be forever, but what is interesting is point D. 3D, the pleas and laws alleging the errors made in connection with the Commission's primary line of reasoning. And what happens here is that Ireland and Apple basically said, first of all, the Commission does not understand how Irish law works, by saying that this should have been at arm's length under the arm's length principle, and that whatever was outside the branch should be allocated to the branch because there was nothing in the branch. And secondly, and this is point 3 that you can see here in the middle, they said that the Commission didn't understand exactly how Apple worked, because actually all these decisions were taken by Apple. So we're going to look at these and the fallout from those in a transfer pricing perspective, because it really raises interesting points. And then just for those among you who are not from the EU, point C of the pleas here under law dealt with the fact that Ireland and the taxpayers say that the Commission didn't have competence to make an adjustment for state aid when it comes to taxation. And the argument goes something like this: the Treaty on the Functioning of the EU divides the competences between the member states and the EU, what the EU will take care of and what the member states will take care of. And direct taxation, it is true, is not included in the competences of the list of the competences of the EU. So technically the EU cannot deal with direct taxation. However, for the past, and this is the point that Ireland and the taxpayers and maybe the American advisors of the taxpayers were trying to make. However, for the past 20 plus years, it has been doctrine with the EU that the Court of Justice have consistently said, it is true, the taxation does not belong to the competence of the EU. That belongs to the member states and they can do it. But the member states have to practice their competence with regard to their own taxation within the confinements of the treaty. In other words, if the treaty says you cannot discriminate, then you cannot use taxation to discriminate just because taxation doesn't belong in the competence of the member states. The same with restrictions on free movement, free capital, freedom of services, freedom of workers, all those things. You cannot use taxation to restrict the freedom under the treaty, and the same applies here. Taxation is something that member states arrange for themselves, but they cannot provide state aid through taxation, claiming that that taxation does not belong to the competences of the EU. So that point, just to move it out for those of you who are not from the EU, and then let's go to point D. Now, what is point D about? Basically, Ireland and the taxpayers said that there were errors made in the Commission's primary line of reasoning. And what does this mean? It means basically that they said that the Commission don't understand how Irish law works, and the Commission does not understand how Apple works. That's basically what it comes down to. So by way of reminder, the court says the Commission contended that insofar as the head offices of AC and AOE were unable to control or manage the Apple Group's IP licenses, and remember the Commission says they couldn't control it because there was no one there to do the controlling. There were no significant people in these companies outside of the Irish branches, right? So insofar as the head office couldn't control anything, those profits should have been allocated to ASI and AOE's branches, because that's the only place where the functions were, which alone would have been in a position effectively to perform the functions related to the Apple Group's IP that were crucial to ASI and AOE's trading activity. And again, remember, under the cost contribution agreements, that IP was, at least the economic ownership was allocated to these companies and out of the US, which justified why they received all the residual profits for sales made outside North and South America. So the Commission goes on and says, in addition, the Commission specified that the phrase profits derived from the use of the Apple licenses had to be understood as meaning the profits resulting from the allocation of economic ownership of the Apple Group's IP licenses to the Irish branches, which corresponds to the profits derived from all of ASI and AOE's sales activities. And then what Ireland and taxpayers says, first, Ireland criticizes the method of analysis used and says the Commission did not analyze advantage and selectivity separately. We'll have a brief look at that. It is a technical point on how the Commission is supposed to pursue unlawful state aid. And then next, and this is what the beef of our discussion, the Ireland, ASI and AOE challenged the conclusions. They argue that errors were made in the assessment of the reference framework and normal taxation under Irish law owing to incorrect application by the Commission of Section 25 of the TCA, the Tax Companies Act, I assume, 97, and its application of the arm's length principle, and its analysis in light of the OECD 2010 report on the attribution of profits to permanent establishments. So both it got Irish law wrong, and then when it got the application of transfer pricing wrong, and then when they applied the AOA, they got that wrong too. Is basically what the taxpayers in Ireland say here. And in addition, Ireland and ASI and AOE challenged the Commission's factual assessments concerning the activities within the Apple Group. So if we look at how the court dealt with these arguments, it first talked about this joint treatment of advantage and selectivity, and we'll deal with it briefly. Then it looked at the normal taxation under Irish law, and this is really where the Commission lost the case. And it talks about the activities within the Apple Group, which didn't help. And then it comes to the conclusion, which basically is that the Commission lost the case because of the way normal Irish law works, which is strange for Ireland to have admitted, because basically they confessed that they were a total and utter tax haven. But let's see. If we deal with the joint treatment of advantage and selectivity, Ireland argues that the Commission disregarded principles well established in case law by conflating the conditions of advantage and selectivity. And we'll see in a moment how that works, because the court explains it. The court then says it should be borne in mind that selectivity and advantage are two separate conditions, right? In respect of advantage, the Commission must show that the measures improves the financial situation of the recipient. In other words, that Apple saved money or saved taxes. In respect of selectivity, the Commission must show that the advantage is not enjoyed by other undertakings. And so what you have to see, state aid, first of all, there has to be aid, right? So someone has to give something to someone else, and the government must give something to a taxpayer when it comes to state aid in taxes. And so that is the advantage, right? And then that is not enough. That is not state aid yet. State aid is if you treat someone better than you treat other people. So if the government gives money to everyone, that is not state aid, because everyone is on an equal footing, but in their country, right? Doing business in their country. But if they only give it to some and not to others, then this is where it becomes state aid, because then you are falsifying competition between companies, and it was on this point of selectivity that the Commission ultimately faltered, because they could not show that the rules as they were applied by Ireland to Apple would not have been applied exactly the same to others. And in fact, there is case law which they quote, which shows that it has been applied in the same way. But so the first argument, purely technical, you should have done advantage and selectivity separately, and you didn't. And the court deals with it quite shortly, fortunately, and it says, it is apparent that the Commission examined to what extent the contested tax rulings had led to a reduction in the amount payable by ASI and AOE. In other words, that was an advantage, right? In order to show that those rulings have given those companies an economic advantage. So they have looked at the advantage. And then the Commission also examined whether by reducing those undertakings' annual chargeable profits, the contested tax rulings had derogated from that framework. And the Commission has done that, because it said, you know, you're supposed to apply transfer pricing rules to everyone, which your law says that you do, and you didn't do it here because this was not the right transfer pricing approach that you've done. So they have looked at advantages and they have looked at selectivity, and the court then also concludes the complaint raised by Ireland must therefore be rejected as unfounded, so not well established in case law. So just to summarize again, with regard to the joint treatment of advantage and selectivity, the Commission did examine both for selectivity and for advantage. The fact that the Commission did this simultaneously is irrelevant. It happens more often in matters of taxation. So now let us look at the argument that the Commission didn't understand Irish law. And the first thing was the reference framework. So Ireland and ASI and AOE claimed that the relevant reference framework in the present instance is Section 25 of the Tax Act, a separate charging provision to non-resident companies which are not in a situation comparable to that of resident companies. And you've got to understand that under EU law, one of the most difficult things when it comes to discrimination, restrictions on rights and state aid is you've got to compare like with like. And the question is, what is like with like, right? So what are comparable and what is not? So what Ireland effectively is saying here is, listen, we've got this law which says that non-doms are only taxed to the extent that they have business in Ireland. And that is a separate provision. You cannot compare that to normal Irish taxpayers, because normal Irish taxpayers are taxable on their worldwide income and non-doms are only taxable on their Irish income, so therefore they are not comparable, right? And a lot of cases in EU law revolve around this. But it must be differences that matter. And the question here is whether these differences matter. And the court effectively says no. It says under Section 25, and the whole question here is about the applicability of transfer pricing rules, right? Under Section 25(1) of the TCA, non-resident companies are not taxed in Ireland unless they carry on a trade through a branch or its agency. If they do so, they must pay corporation tax on all their chargeable profits. It's a typical PE article, right? Section 25(2)(a) defines chargeable profits as any trading income arising directly or indirectly through or from the branch or agency, and any income from property rights or rights used by or held by or for the branch of the agency. Very, very typical PE language, permanent established language. And then the court says, well, but you got to look at what the purpose of the law is, right? Although the first part of the first sentence of Section 25(1) could be understood as establishing a derogation, in other words, something separate, which is not comparable from the normal taxation regime. The second part of that sentence makes that regime applicable to non-resident companies carrying on trade in Ireland through a branch. In other words, if you do have a branch, then all the normal tax rules on depreciation, on what is deductible, what is not deductible, what the rate is, etc., all of those apply. In accordance with that provision, those companies are also subject to the conditions for the application of corporation tax. And then the conclusion is, resident and non-resident companies carrying on a trade in Ireland through a branch are in a comparable situation in the light of the objective pursued by that regime, namely the taxation of chargeable profits. And the court then concludes, in those circumstances, it is appropriate to consider that the Commission did not err when it concluded that the reference framework in the present instance was the ordinary rules of taxation of corporate profit in Ireland. So this point, the Commission won.